welcome to Wall Street for Main Street podcast special. I'm Mo Dawood alongside John Manfreda. Our special guest today is Peter Grandich. Peter, thank you for joining us tonight.
Thank you for having me, gentlemen.
All right, the first question I wanted to is we wanted to get into your background a little bit, and what stood out to me the most was that it said that you didn't finish high school, and if you look at a lot of the educational arguments, they're saying you need a college degree, that we need all this education, have a great productive workforce, yet you're one of the best and you didn't finish high school. And I was wondering, what do you think when they hear about, we need education?
Well, I think it was the education guys that got us all into trouble in the last financial crisis, when they all thought they had everything figured out computer-wise and quantitative-wise, and yet we all know the crisis was led by that. So I guess because I've learned from the school of hard knocks and on-the-job education, I wouldn't trade it in. I mean, I do understand the need to have some understanding, and I certainly wasn't anywhere knowledgeable in the early years I was in the business than after 30 years. But to be real candid, and even though I'm singing to the choir because the way your question was led, I can tell you they can keep all the education. I wouldn't trade the on-the-job experience that I learned from. And I think that's part of the problem of the financial service industry. And one of the things I've always argued is many of the people that go to work in the financial service arena come in after college education. They go into some training program at a financial institution. And one thing they're robbed of out of that, and they don't even realize it, is they don't learn anything about mental anguish. And mental anguish comes with the territory in this business, and you don't get it until you've actually lost money. And many of these folks go right into making money off of other people without ever experiencing losses themselves. And one of the things I've always felt, and why I don't believe in traditional financial planning, is most financial advisors can't measure the potential anguish their advice can cause people. They may have a good heart and they may care, but they'll never understand the emotional anguish that people suffer from losses, sometimes far worse than the financial ones.
And that's a great point. And we'll go into personal finance a little bit later in this interview. And you talk about the education in this country. With the college tuition increasing cost every year, which is currently in a bubble among other type of debt in this country, it makes it less. I would say, not worth it just to go to college, which is increasing costs in the college education. And some people, when they graduate, are having a hard time finding jobs as well.
Well, there's a lot of studies coming out now questioning exactly what you just said, seeing whether or not, when you think of the expense and the debt burden, that if it's not the families that had to go through savings, the kids themselves carrying such a big debt burden, to get an education that really doesn't separate them and bring in such a much higher income. And one of the things I hear often from college grads over the years, especially once they hear about my story and they go, wow, I went to 4 years here or 8 years here. Many of them say that they never really got the bang for their buck that they expected when they went to college. So I think with all the high cost of college and how much more debt is occurring on people to get to college, that's probably one of the next factors or semi-crises America's going to face, and that is the cost of higher education.
Yeah, I definitely agree with that. And I was actually wanting to switch topics a little bit, and I wanted to go into the precious metals. Right now, it got a nice little pop after quantitative easing, and then it seems like it's in another correction or consolidation phase. What's your viewpoint of precious metals? Where do you see it going?
Well, I've coined it the mother of all bull markets. Now, mind you, I've been in this almost 30 years. I don't expect, even though I'm so-called only 56 years old, to ever see a bull market like this in my lifetime. But at the same time, I never thought from the first day I worked on Wall Street to now that we could ever have any market of any real size, whether it be precious metal stocks or bonds, go up for 10 straight years and still see so many people not only not believing in it, but so few participating in it. It's been the most stealth bull market I've ever known, or anything that I've known in history, and that's one of the many reasons why I remain bullish. It's not a market that's oversaturated like the equities got or the real estate market got. It still has a very long way to go in that regard, but it also has 3 or 4 fundamental factors that remain fully intact at why I stay so bullish. The first 2 are really things that were once hindered the gold market. Years ago, central banks were major sellers of the gold. They sold it every year, and they sold it without any plans and any caring of how much was into the market. Then the Washington Accord was struck several years ago, where they agreed to limit their selling. And in the last couple of years, they never even came close to the amount that they could sell, and actually we've seen central banks as net buyers. That was a tremendous change. The other change that took place was it was very fashionable in the 80s and 90s to be a gold forward seller. In fact, the old American Barrick, which is now known as Barrick Gold, really made a living more as a derivative seller than a gold producer, and it was able to achieve much higher prices for a gold price simply by selling it forward and hedging. Now, forward selling for years has been a dirty word, and institutional and private investors don't want to own any gold producer if they're dramatically hedged. So that was a big negative that turned to a positive. And then the last thing that really changed the market forever and has kept it in this very long-term bullish stance, in my opinion, was the creation of exchange-traded funds. Now, I'm not here to argue whether or not they really deliver pure ownership of gold when the time comes, if the time comes. But what I'm here to say is it opened the door to people who were never buying gold in the first place beforehand. We just continuously see higher and higher record holdings of the gold exchange-traded funds, and that's mostly people who would have not bought gold at all before or might try to use the old proxy of mining shares to own it. And those 3 factors alone, since they still remain constant, continue, in my opinion, to drive the gold price higher. You throw in other things like the world printing money and everybody's debasing its currency. You're talking geopolitical concerns and fears of economies and what have you. All the lights remain green as far as I'm concerned when it comes to a higher gold price.
And that's a great point. And you talk about how under invest gold and silver is right now. I believe the number is that less than 1% of our portfolio has some type of exposure to gold. So this bull market, people are saying it's in a bubble. How can it be in a bubble when really no one owns it and everybody dismiss it as a worthless investment or as an emotional metal where anytime something bad happens in the economy or in other parts of the world, gold goes up. But as you said in this interview, gold has done very well compared to other investment classes. It at least guaranteed double-digit returns in the past 10 years, I believe. So just imagine what happened when 5% of investors have gold in their portfolio. We could see a big increase in their gold prices.
The thing that's been difficult for people to understand, and we're going through it again because there's this typical raids that happen along the way as the price moves to higher levels, these bearish raids that take place. People have to, one of the tough things for people who are bullish on gold, and mind you, that bullishness was tested earlier this year when we were in the low 1500s, and we saw most former bulls running to the hills, actually turning bearish, and the bloodied bears who had been wrong for 10 years again got a lot of the media attention, and again for the umpteenth time predicted the end and the downturn in the gold price. What people have to remember is gold is a hated investment among the investment community, and this is critical for people to understand. When you're in financial arena, your livelihood is selling financial assets. And just if you were a car dealer, you wouldn't suggest to anybody they'd be better off with a bicycle. Well, you're not going to see people in the financial community who make a living dealing with stocks and bonds and other instruments in that area suggest that you should own gold, because almost all the reasons to own gold would be on the suspicious that the other financial assets may not do as well. So you're just never going to get the financial community and most of the media that follows it to speak highly of gold. The other thing that you have to remember about this is that there's really two markets, and this is hard for the average, maybe not hour-to-hour player in the gold market to understand. There's the paper market, or what we call the futures market, which is dominated currently in New York on the COMEX. And then there's the physical market, which basically trades almost all the time when the COMEX is not open, except they do coincide between 8:30 and 11 o'clock Eastern Standard Time, when around the world physical trading is taking place and the paper market's trading place. And it's very hard for people to understand, and this interview isn't long enough to explain it thoroughly, but we have seen now for several years the physical market become stronger and stronger, and the paper market, where some of us, a small but I think an important group who's been more right than the people who say that we're wrong in our opinions have been, and that is that market is where certain people have used, if you want to use the word manipulate, or at least strive to take advantage of moving the market to the downside. And that's one of these little raids that the gold market's currently going through in the paper market. But what's real important, and again, what I've said now for several years, it's the best of all worlds they created, because they created a 2 steps up, 1 step back bull market. And those are the healthiest bull markets. They last far longer. They allow the adjustment to take place in an area that most people forget, both bulls and bears in the gold market, to discuss, and that's jewelry demand. Like it or not, jewelry demand is still the single biggest influence on the price of gold. About 65% of gold's usage is in the jewelry business. And so jewelry demand is sensitive to large-scale price increases over a very short period of time. Historically, whenever we see large-scale runs in the gold price, jewelry fabricators pull back because retail buyers of gold pull back. And so it's important and very useful to have these corrections and consolidations that gold has gone through, because it allows the public demand for jewelry to stay constant despite a moving up in price, but a price that people can live with because it doesn't move up too far and too fast.
And that's a great point. And I have another question, and that's regarding the mining stocks. And as of late, it's done pretty well since late summer compared to the physical market. Now, in the long run, do you believe the mining stock will outperform the physical market during this major bull market?
I think if we were speaking just of major producers, my answer would be close to yes. Unfortunately, and this is where I make my living, so you would think I would want to be more bullish, but I'm trying to be realistic. I think as we go down the food chain to the smaller juniors, explorers and all, it's going to be more difficult to match the performance in gold. One of the reasons is there's been a great change in that market. Despite a five-fold six-fold increase in the prices of gold and silver and some other metals, it's actually more difficult now to be a miner and explorer in the world for a whole bunch of reasons, political, environmental, but nothing more importantly than raising finances. It's still quite difficult, and because of the great bear market that we suffered for most of this year in the junior resource market, it's going to be especially tough for months to come for that junior market to get back on its heels and really have a sustained move. The only asterisk I would put with that is two things. One, it'll be easier to move once this year is over, because people just act in calendar year mentalities, and they'll sell things for losses just so they don't have to deal with it coming new year. And two, we could, in the first quarter, I believe, especially, see a substantial move up in the gold price, and that will just rise and raise all boats, and juniors as well as major producers. But I think the higher you go up the food chain to emerging producers to actually bigger producers, the less likelihood you'll see a big difference between the increasing price of gold and the price of mining shares in general.
All right, that's a pretty good point, I would say. My question is, speaking of the juniors, do you think having a small section for juniors could I would say, duplicate the 70s. The only reason I would say is because I think some juniors, if you pick the right juniors, will get bought out by the big boys. I would say like a Newmont or a Barrick. Do you agree with that, or?
No, you make a very good point. The majors have spent limited amounts of money relative to where they've spent elsewhere on exploration. They have, in a sense, grown dependent on juniors to find and develop deposits to a point where they can take them over. Most of the big producers now produce so many million ounces of gold and tens of million ounces of silver a year that they need to replenish it in a big way every year. So I believe there will be somewhat of a separation even within the junior market over the next 6 to 12 months, and that is companies that do have a viable deposit that's either been totally de-risked or on its way to being de-risked are likely to become more aggressive takeover targets, and that's where we'll have the separation. I also, listen, the bulk of my investment dollars, if you want to call it an investment, I always call these things gambling, but gambling, speculation, or whatever we want to call it, are in this field. But I'm trying to be realistic. We've had a very damaging year. It's going to take some time to recover, but so many companies that shouldn't have been thrown out with the baby with the bathwater were. So I expect, particularly probably in the latter part of this year when the bulk of tax selling is over, and particularly in the first quarter, is where I see the real good possibility of a major run in the junior resource market. And
that's an excellent point. And I want to touch on the state of financing for the junior mining stock. Now, we interviewed Sandstorm Gold CEO Nolan Watson, and he made a comment how a lot of the junior miners with the market cap less than $10 million will have a very hard time surviving in this environment where they either go bankrupt or they have to shut down the mine or have to sell their assets for pennies on the dollar. Do you share the same point of view as Nolan Watson on the financing?
He makes a good point that we should consider, and that is those royalty-type companies who are in a primary position to take advantage of these companies that are gone, unfortunately, in a bad way, and they could buy maybe pennies on the dollars, are going to be the ones that will really profit from that. One thing about the junior market, I don't call it a saving grace, but it's not quite like anything else, is most juniors don't die. They become born again, and what I mean by that is most of them go through a consolidation and rollback kind of phase. And they may change properties or the properties change names, but they don't truly die, a lot of them. But in this particular case, because there was such widespread damage and financiers are just not in the position to do the deals the way the juniors would like them and know that they literally have to come with their hands open, I think he's right in that sense, and it's going to be difficult for some. What I think surprisingly we're going to see as we get into that last month when a lot of people go away and kind of close their books or their thoughts on the year, we're going to hear a lot of announcements of rollbacks. We're going to hear companies that have gone to 90 to 150 million shares outstanding and not very advanced on their project yet, announcing 3 to 5 rollbacks, things of that nature. One of the other things we'll see is a lot of repricing of stock options because that's a driving force to keep people in place at these companies. But I think the worst of the worst is over, but we need to really get to the first quarter of next year before we can really have long-term optimism that we can see any sustained rally in the junior market.
All right, that sounds good. I agree. I think tax selling loss will take some of the spark out of it. And I was actually wondering also, you predicted Black Monday, and you have a lot of good predictions. Right now, it seems like the stock market, sort of like the resource stocks, got a pop from the quantitative easing announced by the Federal Reserve, and now it's, the earnings are really bad, and it's really either correcting or crashing. What would you say? Do you think right now the stock market's in a correctional phase? It got too ahead of itself, or do you think we're crashing? What's your thought?
I'm a little bit unique this year and have been for several years. In fact, in the hard asset camp, normally when you find people that are bullish on gold, they're almost automatically very bearish on the general equity market. While certainly not a roaring bull, my attitude since March 2009 was the least resistance in the market is higher, and I've began this year, a couple thousand points lower, thinking that they could actually eke out a marginal new high in the Dow. That wasn't because I was a roaring bull or thought equities were a great place. It's because I've operated almost 30 years now with this assumption that there's what I've coined the don't worry, be happy crowd that controls Wall Street. And with the quantitative easing and with the full opening of the spigots, what I don't think the average American realizes, and that's why I think Obama still manages to hold on in some polls, is they don't understand the ramification of what the Federal Reserve has actually done, because almost everybody, probably including within my own family, doesn't even understand how money's created. To this day, they don't understand that we literally create it out of thin air. And again, I know this interview is not the time and place to go into long detail on that, but understanding that and understanding what the Fed did in its most recent announcement, in my opinion, and I know I'm not alone in this, it shot the silver bullet. It made the Hail Mary pass. It has thrown in the kitchen sink. It really has totally committed to somehow believe that they just can create enough money and they can put enough money in the system and asset prices can increase, the stock market goes up, interest rates stay low. Somehow that turns around, people start working again, and everything gets better. But in my opinion, obviously those of others, is that by doing so, the cost is too great. The debt levels have become too enormous, and it's gone past the point of return where America, and again, this is where even financial people fail, don't understand cash flow. People make a big mistake. I have another business, and it involves an alternative to what we call traditional financial planning. Most people chase net worth. You say, look, if I can have so much dollars and then it can earn so much, I can live happily ever after. But real success, meet any successful business person over time, they'll tell you the key to any success is a person's cash flow. And the easiest way to describe that is, would you rather have $2 million of real estate that you can't sell, that you got to service the debt, and you can't make any money on it because it's a land that someday you hope somebody's going to do good with, or would you rather have $500,000 in cash and be able to use it? Most experts that understand money will say cash flow is more important than net worth. Well, the problem why I explain that is we don't produce enough cash flow now as an Americans to service our debt, let alone pay down the debt. And that's a big thing that people don't talk about. We not only can't pay the debt, we're getting to the point where we're not going to be able to service it, which means that if interest rates increase to a certain level, the amount of interest we're going to owe, we're just not going to produce as Americans after we pay for our homes, we pay for this and that, enough to service that debt. And that's where the real problem lies. And again, it's not something that often spoke about, but that's the real critical long-term problem. So that's why whether the stock market, in my opinion, makes this new high or not, whether this month or early next year, if you ask me where we go in 1, 3, 5 years from now, we have a huge, huge problem, bigger than anything to be solved. And that's why, as bearish as I am longer term on the stock market, I think the worst investment anybody can make for the next 10 years is in the bond market. That's where I think absolutely large-scale loss of principal is coming down the road.
And I agree there. And the yield on it in the Treasury market is almost zero, almost nothing. It's like depends on what the Treasury bond you buy. That less than 1% or 1.5%, somewhere in that area, and that's almost nothing when you factor in the inflation that's going on in the country and around the world. You're getting negative returns on your investment when you invest in the bond market, which is a big deal because a lot of the people that are retired rely on bonds as their fixed income.
And you bring up a good point, and let me just add, this is very important for people to understand, is unlike a stock where that company may find a new revolutionary product or service and people will pay many times the price of the share that you bought it at, in bonds, you really only have you're buying it and you're hoping to get your principal back whenever the term matures. The problem is if rates are down to where you're getting something that's only 1.5, and all they do go back to 3 or 4%, the value of that bond that you had lost. Now people say, well, I can always hold it to the end. Well, that's true, but you're going to be stuck with 1% yield when everything else is yielding 4%. So your purchasing power and ability to stay afloat is going to go backwards big time. And that's what the story, when I talk about, somebody asked me today in an interview, what's the one story that isn't being told in America and should be told if you had a chance to talk about the election, not for one person or another? And that is that people don't understand that we are dead because of a cash flow. We can't produce enough to keep going forward in the way we can. And we could argue all about, well, more people and the government's making more entitlements and all that. That only makes the problem worse. But we can't service what we already have, let alone what's coming as we keep adding to this problem. And that's why most people feel eventually the currency has to be debased. And then again, we go back to gold. Well, if currencies are being debased, people aren't going to have faith in paper money, so where are they going to turn? They're going to turn where they've turned for thousands of years, to the gold market.
And that's an excellent point. And the final subject I want to touch for a little bit is personal finance. And I recently read an article, which I found on your website, that a recent survey that came out that 40% of all Americans only have $500 or less in saving. And, not all of them are poor. And some of them have money and they're not saving. And I can understand that in the high inflationary environment we are right now. It's hard to save. So I want to ask you, how did American personal finance behavior change to be this way?
We went from let's not forget that we went from the world's largest creditor nation in the 60s and early 70s to the world's largest debtor nation. And you can only do that by really changing the way you live and how you go. And I've always said that the biggest change in 30 years of being in the financial service business on one side or another has been, the saying 30 years ago was, can we afford it? Now the saying is, can we make the payment? And that's another cultural attitude change that Americans made. The difficulty that we have, and you bring a very good point, is a far worse number than that is this. When I, 30 years ago, entered Wall Street, having $1 million was supposedly, if you could have that, you can have a good life and what remains in your retirement or what have you. And obviously that number's higher now, although some people still use it. Well, Social Security Administration said last year that less than 8% of the entire American population has less than $100,000 of net worth. And so when you think about that number and you say to yourself, okay, they don't have a lot of savings like you pointed out. They don't have assets that are increasing. Think about what's transpired in the last few years. The hardest hit people in America are the people that are left with the wealth. 80% of the wealth in America is owned by people 55 and over. And if you look at what's happened to the average person at 55, 65, and 75 in the last 10 years, it's a very dark cloud. One, you said it before, they used to live dependent on interest. And they would have a certain amount of money and they would earn interest, and that could get them by and go forward. Well, we saw where interest rates went down, so nobody can live on 1 or 2%. The large sums of principal you would have to have, almost no one has. The second thing they were told, especially when I entered the business in 1984, was over time stocks and home prices go up. That's all that was built into your mind. Over time, as long as you held stocks and homes and real estate, they would go up. Well, what's happened in the last 10 years with that? Now, the last basket of things that those people had that they depended on was really, compared to around the world, a platinum health care policy. Medicare is when you think about what you can get for it without paying anything really for it other than a little supplement policy, that's a lot of stuff for very little money. Well, that can't last any longer either. That's broke, has to be fixed, and one of the things that'll be done is you'll have to pay more to get less. So if you look at what the people still with the largest percentage of money that's left in America are facing, that's a very interesting factor. And then factor in this. They're the single largest voting bloc in America. So whether or not that shows up in this election or it takes one more or two more, But eventually, sooner or later, when the crisis reaches, and I don't want to run on with you, but I do want to make this point, I don't want to forget it. We've seen a preview of what's coming to America. It's what's happened in Europe in the last few years. That's what's coming to American shores. And I don't think Americans are going to act anywhere different. I suspect they're going to still demand that the government do something and the government pay, and they're not going to like big austerity programs and see a lot of things cut back and so forth and so on. So whether that's part of the deciding factor after they look at this election or it takes place in the next one, it's coming. And that's why, again, other than a very short-term view that the equity market can go up, it's one of the main reasons why, I think bonds are a real bad bet, and over the long term, gold only has one place to go, and that's higher.
Yeah, go ahead.
I'm sorry, go ahead, John. I was going to say,
well, one thing about, I hate to be such a downer, is in terms of Europe, I believe Germany actually has a strong, vibrant economy and lots of exports. The U.S., we hardly export anything besides paper money, so I think we could actually be worse than Europe. So that's just my opinion.
Yeah, and you make a good point. When we say Europe, we need to include the majority of the countries that are not anywhere in the shape that Germany is. And I think Germany has stayed in that position to be in a position of strength when the time comes. And so whether or not it's severe or as severe or worse, the demographics, by the way, that I just pointed out, and that's all part of the aging crisis, that's happening worldwide. We've seen it in Japan. We even see it north of the border, not to the great level that we face, but even in Canada, there's a difficulty with demographics. The difference in Canada and why several years ago I placed 90% of my hard dollars from U.S. dollars into Canadian dollars is Canada can be self-sufficient. It can not only feed itself, it can provide the energy it needs and the water that's going to need. And believe me, water is going to come a crisis over the next couple of decades as well. So, again, outside of a very short-term view that the equity market in the U.S. can go higher, longer term, I believe things are going to get quite bad in America. And one of the few areas that I think that can, do well and go up on the long side continues to be the gold market.
And that's a great point. Well, Peter Grandich, thank you for coming on Wall Street from Main Street podcast. If people want to find out more about your work and what you do, where can they go?
Grandich.com. That's Grandich.com, and everything there they need to know will be found at that site.
Okay, great. Well, thank you for coming on. Hopefully you can come on in the future.